Okay, so we can start our meeting. And first of all, I would like to thank Giulia Miotti for accepting our invitation. And Giulia will speak about transparency and financial markets, some issues and new perspective. Giulia works at the University of Turin, and so we are pleased to have her as a host of the Financial Line seminars. As usual, after the meeting, we will have debate, and everybody, of course, can ask questions by using the virtual hand at the bottom of the menu, the Zoom menu. And so, without much further ado, I say you can start the meeting. And so, Giulia, the floor is yours.
Okay, thank you, Emiliano. So good evening, everyone. Thank you for being here, and thank you, Emiliano, for having me here. So I'm very, very happy and very glad of discuss these topics with you today. So as I was saying to Emiliano, I'm very sorry, but I prepared some slides for this talk, but due to some cognitive biases that I have against online presentation, I'm going to read out the paper I prepared for it. I'll try to read as slowly and as clearly as possible. If you like, I think that you all do have my email. So if you wish, I can send you the slides soon afterwards the talk, or whenever you want, just write me an email, and I'm happy to send you either the text or the slides as you wish. Okay, so I'll move on. I would like to discuss the issues of information, transparency, and accountability in today's financial practice, starting from the notion of information as it is described within mainstream financial theory and practice, and then moving to an overview of two approaches alternative to mainstream financial practice engaged in enhancing transparency and accountability. Namely, these are the latest EU policies and the practice of ethical finance and banking, as it has been developed throughout in the last 20 years, at least in Europe. So transparency is nowadays a concept of critical importance when it comes to the promotion of a just transition towards a more sustainable and fair economy. Despite the theoretical importance recognized to information, classical financial markets do not seem to extend such recognition to the practice of transparency and accountability. In the light of such deficiencies, I describe two alternative answers. So as already claimed, one is represented by the Sustainable Finance Disclosure Regulation, so also known as SFDR, which is a set of policies devised to boost the EU Action Plan on Sustainable Finance, while the other one is represented by the alternative model of governance proposed by the practitioners of ethical finance and banking, such as, for example, Banca Etica in Italy and Spain, so at the moment in these two countries, and Europe-wide, the European Federation of Ethical and Alternative Bank and Financiers, also known as FEBEA. The notion of information is of critical importance within both financial theory and financial practice. And I will move from it to discuss how transparency can actually work within financial practice, what might be its positive impacts, and how it's being implemented or not implemented in today's financial practice. So the way information flows through financial markets is central to understand agents' epistemic behavior and their decision-making strategies, and it has a straightforward impact on the chances of success of an investing strategy. In this context, any financial exchange might be understood as an exchange of information, and the main activity of financial players is connected to the search for the best information. Again, in this context, if we want to stretch a bit the importance of information and the role of information in finance, we might even say that information shows a sort of priority over the actual objects offered and traded on the market. Of course, objects and assets are traded on the markets, but it feels like the first and most important trait is around information. Curiously enough, nonetheless, the notion of information seems to be disconnected from the notion of transparency, understood in terms of openness, communication, and accountability. As stated, information plays a crucial role both in financial theory and practice, specifically when it comes to the description of how information available in the market can determine agents' epistemic possibilities, thus describing the models and the cognitive abilities involved in information processing. I shall propose a brief description of the role ascribed to information by the efficient market hypothesis. In fact, it is the existence of correct information and its free circulation in the market that allow financial markets to be a rationally appraisable context and also allow agents to make rational choices and have a reasonable chance not to be overwhelmed by the so-called extreme events. I will briefly focus on a description of how information acts in the description of financial objects and show in which sense the activity connected to information scouting and the quantity of information collected are not necessarily proportional to the level of transparency displayed by financial objects, which tend to remain opaque somehow, or by financial operators' choices and strategies, which tend to remain opaque as well, or not completely understandable. This disproportion between information and transparency has two main effects, particularly clear at the economic and social level. I will call the first one an effect on the systemic level, and the other one an effect on the local level, and I shall provide an example for both. The fact that information does not seem able to provide transparency for the object it allows to shape represents a significant vulnus within financial practice. The financial system is a social system, and a social system which is not able to convey information in an open and comprehensible way cannot be described as a fair or democratic one. According to the Open Government Partnership, transparency, I quote from them, empowers citizens to exercise their rights and participate in decision-making processes, and it thus represents the most efficient strategy to maintain the democratic health of any social institution. This issue is ever more pressing within the financial culture as well. In this respect, it is interesting to read the description of our transparency provided by the Corporate Reporting Dialogue, which is a group established to facilitate discussion between main actors involved in disclosure and accountability. In this case, there are the Climate Disclosure Standards Board, CDSB, and the Global Reporting Initiative called GRI, to facilitate discussion between respective participants on their frameworks for corporate accountability to further advance corporate reporting. And this is rather interesting because both CDSB and GRI are close, we might say, colleagues to the EU technicians when it comes to develop policies concerning EU taxonomy and EU sustainable policies for economic development and financial sustainability. So according to the Corporate Reporting Dialogue, transparency is an open way of communication by an organization on the topic concerned, such that the information is sufficiently accurate, complete, and understandable to enable the user to make relevant decisions. So if in the first entry concerning transparency, the one by the Global Partnership, transparency represents an efficient tool to maintain democratic health of any kind of institution, transparency, as thought of by the Corporate Reporting Dialogue, is especially aimed at boosting good decision-making and trust in finance. And transparent reporting is also recommended as a strategy resulting in a lower cost of capital due to a lower risk profile as a result of a better insight into the operations. As I kind of announced, I refer you to two main approaches. The first one is the one expressed by the Sustainable Finance Disclosure Responsibility, the EU regulation, which has become effective in March 2021, and which promotes transparency on the sustainability level of the financial services sector. The second one is represented by forms of ethical and responsible finance, which boost forms of governance alternative to those usually implemented by classical finance. So I shall describe both these approaches, and I will show how the request for higher transparency can be satisfied by alternative forms of managing financial activities, which endorse transparency as one of the main pivots of their activities. I will also describe, or I would like to discuss, the fact that these two alternative approaches, even though they are both somehow separate and alternative to the classical approach towards transparency, do not seem able to be overlapped. So there is a huge distance in terms of aim, I would say. So we might say that the goal is the same, but they do have a different aim in promoting this kind of goal. And this opens, I would say, I will try to show it. It opens to different practical and also theoretical issues themselves. I hope I will have enough time also to discuss a bit of this. It's a part of an ongoing work that I would just try to discuss it. So a few thoughts about market theory and information. The efficient market hypothesis that I claimed as the main theory concerning financial markets functioning moves from the assumption of neoclassical economics and as its pivotal concepts, those of market equilibrium and agents' rationality. According to these concepts, a market is a system in equilibrium since the collection of economic choices make it stable. So such choices are operated by fully rational individuals in possession of complete and relevant information. So in this context, information has a central part in shaping prices and in assessing future market trends. So if we follow the analysis proposed by the economist Steve Keen, we may even define the very concept of market efficiency in terms of information. And Steve Keen finds out four main elements which may allow us to understand efficiency in terms of information. So the first one is that investors' collective expectations represent accurate predictions of companies' future prospects in the market. The second one claims that share prices fully reflect all relevant information necessary to understand the future prospect of companies in the market. And then that share prices oscillations can be ascribed to changes in relevant information when that information is random and cannot be foreseen. And then at last, share prices follow a random walk so that past prices movements cannot provide any information on future trends. I will delve more into the analysis of two of these aspects, which seem fundamental within this talk, mainly the second one and the third one. So I will move from the second point. If we claim that a market is efficient when share prices fully reflect all the relevant available information, we are then claiming that in an efficient market, the price of any object reflects its fundamental value. In this respect, market agents have correctly processed all available information concerning a given object and have thus created a rational collective expectation on the future flows that will determine the price. In this way, we would have a straightforward connection between the whole of information rationally processed, which is processed by everyone in the same way, and the final result, which is the price. So let's now move to the third aspect, the one concerning price oscillations and market agents' reaction. As claimed, price oscillations result from information randomly occurred, which has an impact on the equilibrium of the share's value. Even if this information is random and non-predictable, it is still at everyone's disposal once it has assessed the market. This characteristic, then, allows agents to react in a rational way and evaluate new information in an objective way, thus readjusting the prices to a new point of equilibrium. If these two principles would hold, then the market would be perfectly efficient. Nonetheless, many others claim that this is not the case, and such conditions represent unrealistic hypotheses and unachievable conditions or objectives. Their feasibility, in fact, presupposes that all market investors may have access to the same kind of information at the same moment, and therefore that all agents have at their disposal the same kind of tool and the same amount of time to gather and process the same amount of information. As Keen claims, such scenario is fundamentally unrealistic. It would be enough to mention two conditions which are necessary for its existence to understand how far-fetched it is from the actual reality of markets. And these two conditions are the total accord among market agents and the availability of almost endless liquidity from everyone. So ideally, anyone can borrow or lend as much as needed. So going back to the notion of information, we find a similar issues as Emiliano Ippoliti claims in his Un filosofo Wall Street. And I'm going to quote, but I'm going to quote in my English translation, so no responsibility for Emiliano if it sounds weird, it's all on me. In modern financial markets, information as a structure so that it may become extremely costly to acquire. And the neoclassical hypothesis of perfect information, which omniscience for financial actors, turns out to be descriptively inaccurate, at the very least. Very often, markets behave in an imperfect way from an informative viewpoint, and within imperfect markets, there is space for power. When knowledge of products, processes, and complex context is unequal and non-uniform, knowledge is power, and some financial actors, if selfish and rational, will be able to exploit the situation to their own advantage. So, as I claimed, the disproportion between information and effective transparency of financial market dynamics produces strong impacts, and such impacts can be exerted at a systemic level or on a local level. So the first one affects the financial system in its very functioning and its resilience to shocks as well, actually. Whereas the second one involves financial practice on a socioeconomic level. So the first example I would like to discuss concerns the 2008 financial crisis, and it represents a case of information asymmetry, it may be said, which is a condition according to which available information is not equally shared among actors involved in the same economic or financial context. I will try to briefly reconstruct the genesis and development of this crisis, but just for the part that actually interests and concerns us in this talk. So the 2008 financial crisis moves from the bust of the US housing sector and then quickly spreads at global level until it becomes the worst crisis after the 1920 Great Depression. It could be hard, I think. So in 2006, US real estate sector had a huge growth, and during the so-called boom-bust phase of the speculative bubble that involved it, a huge quantity of mortgages were granted, also to the so-called non-bankable subjects. In this case, it was the mortgages that were granted were referred to as subprime mortgages, which are loans with a high risk because granted to customers with a high risk of default, be it for their low income, for them having fixed-term employment or previous insolvencies. So following a cycle which is typical of advanced capitalist economies, which is called boom-bust cycle, whereby a process of strong expansion is followed by one of rapid contraction, the housing bubble deflated at the end of 2006. Many subprime mortgage holders became insolvent, as expected, actually was not a huge surprise, due to the rising interest rates, bringing the financial market to the brink of collapse. The transition from what might have seemed to be a financial crisis restricted to a specific sector to a crisis of the whole global financial system, or at least of the richest countries involved in the system, took place in several stages of what might be called a refined financial engineering, in which the relevant information about the objects traded on the market was certainly not incorporated into the value attributed to them. The first step involve bundling individual mortgages into larger packages, creating mortgage-backed security, MBS. So now I'm going to go quite quickly through it because, of course, we will hear so the terms already heard quite a lot since 2008. An MBS is a security that derives its cash flows from its constituent portfolio of mortgage loans. The financial strength of such a structure depends directly on the payment stream of the underlying mortgages. Within the MBS, the various mortgages that compose them are divided into several tiers, depending on their associated default risk. So at the bottom, we will have mortgages with higher default risk. So riskier for investor, but offering high interest rates. And at the top, we will have mortgages with lower default risk. So less risky, but with lower interest rates. It is evident at this point that the relevant information on the structure of the different mortgage-backed security has not been used in a way that would ensure understanding and accountability, nor foster the formation of rational expectation on the part of our market agents. We could stop analyzing the subprime crisis here, but it's interesting to understand how information dysfunction played a role in the development of one of the biggest financial market crises. So the second step of this financial engineering consists of further financial engineering whereby new financial instruments are built from the original mortgages. And now we are coming to the collateralized debt obligation, CDOs. A CDO is an instrument consisting of a set of bonds that are backed by a loan. They are called derivative instruments because they derive their performance and thus link their repayment to a set of underlying collateral instruments. In this case, the collateral instruments were mortgage bonds. To construct a CDO, a rather large set of individual collaterals bonds of modest size is bundled together. These bonds are then divided into tranches that have different levels of priority and soundness according to a cascade model whereby in the event of the failure of the underlying bonds, the high priority tranches will be paid first and the others to follow until financial availability. A CDO is generally divided into several sections. So let us assume, for example, that it is divided into 7 sections. In this case, we will have at least 3 or 4 of these, which are likely to have a very high rating, while at least 1 will have a very low rating. So although most of the CDOs issued between 2006 and 2007 contain subprime mortgages with a very low rating, thus expressing a very high risk, they were rated high. The subprime mortgages were cut into several tranches embedded in contexts that lowered their risk by offering high yields. Their origin and the assessment of their potential resilience are in this context not considered relevant information for the correct assessment of these products. In fact, their potential risk is considered acceptable because it is balanced by a probabilistic calculation. That is, unless there is a very strong correlation phenomenon between the failure of several mortgages, so at least unless there is a general crisis in the estate sector, these products can be considered safe. So it is not in our interest to retrace the different stages through which the financial crisis linked to subprime mortgages was formed and then erupted. Instead, reconstructing the structure of the different financial instruments created out of subprime mortgages and the manipulation of information regarding the nature of mortgages as collateral instruments is central to our discourse. What seems particularly important to note here is how the relevant information on subprime mortgages as building blocks of more sophisticated financial instruments was not reflected in the value attributed to CDOs. The value we refer to here has a twofold significance. We are referring to both the market value in the sense of the price attributed to the various CDOs and to the rating accorded to them, which is supposed to express a form of balance between the risk that a given financial product entails and the interest rate it can offer. In addition to a lack of transparency, this aspect shows how the manipulation of information within classical financial practice contravenes the very criteria that define the efficiency of a financial market. The correspondence between value, price, and information has in fact been substantially betrayed. It could be art, actually. Causing products to circulate and be traded within the market that are essentially unknowable, in a way, in their structure and in their potential effect on the market's performance. So as I tried to explain with the example of the subprime mortgages and their effects on a global scale, the problem of information manipulation can have systemic effects on the financial market. So the second type of effect I mentioned is instead, as I was saying, of a local level, of a local kind, which is it concerns the possibility for investors to fully and easily understand how many and above all, which actors are involved in the financial activities supported by their investments or by their savings, and thus to understand and establish the type of impact at a social and economic level that they do or do not contribute to generate, or they do or do not wish to generate, actually. At the local level, therefore, the problem of information management takes on more markedly the contours of a genuine transparency problem. Returning to the definition of transparency proposed at the beginning, a behavior is transparent if it allows the actors involved to exercise their rights and actively participate in decision-making processes. Rereading this statement from a perspective that can incorporate the point of view of investors in the financial market, we will have to think of the possibility of the latter exercising their rights as the possibility of having their rights to information guaranteed. In the context of classical finance, the issue of transparency takes on a twofold connotation. The first concerns the typical form of governance of finance, whereas the second concerns what role ethical consideration should play within financing and investment choices. As we have seen in the case of the subprime mortgages crisis, the construction of new financial instruments often takes place following a rather complex mechanism, within which tracing back the original instrument and its most relevant characteristics can prove difficult. A similar mechanism occurs in the case of investments, within which savers or investors may know the final investment objective, but are unable to gain access to the path of the flows that they themselves help to finance, thus missing out on the possibility of understanding how much and which realities they support in the course of their investment. This lack of transparency takes on the contours of a governance problem because it implies a hierarchical and pyramid-like form of information management within which only a few participants are entitled to direct and full access to information. As mentioned earlier, the issue of transparency also raises a further aspect that should be of central importance within financial practice and choices, that of the role of ethics in financial choices and operations. The two basic functions that the financial system performs to ensure stable economic growth are income redistribution and value creation. Although these functions are of great importance and place financial operation within a broad context of action that includes a very wide public, they do not yet seem to have taken on board ethical demands and developed strategies to make financial operation fully transparent and sustainable. Classical finance, in fact, does not seem to have addressed the question of whether it is always right to invest in any sector that presents opportunities for development, or whether some areas, while offering great market opportunities in the short to the medium term, should be ignored in favor of others that guarantee redistribution of resources and value creation in the long term. For example, market sectors that should not be encouraged according to an ethical and sustainable approach are those that generate particularly negative social and environmental impacts. Ethical finance practitioners, therefore, undertake not to invest in the army market, for example, tobacco production and trade, or gambling. Other markets that are not considered are those related to for example, the development or use of nuclear energy, genetic engineering, oil and mining, and pesticide production. So any sector that is considered to have possibly very high yield in the short term, in the medium term, but possibly very disruptive impacts in the long term. So despite high guaranteed returns, in fact, these sectors generate a highly negative social and environmental impact on future generations as well. From an ethical and sustainable finance perspective, these negative impacts not only make these kinds of investments unfair, but by exerting a critical negative impact on the chances of good social and environmental development for future generations, they are also economically unprofitable in the long term. So, a few words on new transparency proposal for financial practice, which, on the other hand, endorse or try to endorse transparency and a more ethical and a more long-term perspective, which might include future generations as well. There are two main counter-proposals to information management and the lack of transparency within classical finance. So the first one comes directly from the EU, within policies aimed at helping investors recognize and choose sustainable financial strategies. The second from the well-established practice of practitioners and scholars of ethical and sustainable forms of finance and banking. The first counter-proposal is the Sustainable, as I said, Financial Disclosure Regulation, which was introduced in 2018 as a legislative proposal and has become effective in March 2021 as a central strategy to the Sustainable Finance Action Plan, together with the EU taxonomy and the low carbon benchmark regulation. So the whole package of the Green Deal of the EU and all the European policies to turn sustainable within 2030 or 2050 now. The SFDR aims to improve the clarity and comparability of disclosure strategies within financial products and policies by proposing a common grid for all financial agents that allows for a uniform reading and understanding for investors, so that they can easily understand the direction of the investment lines they participate in. The regulation is therefore intertwined with the policies proposed at the European level to promote sustainable industrial production and economic development. In this sense, the SFDR represents the innovation of the financial sector that is necessary and complementary to the innovation of the industrial and economic sector that European sustainability policies would like to promote. So that's the part of it's the financial backspine for the new industrial strategies of the EU. Therefore, the strategy includes a clear call for greater transparency, because in a sense, according to the EU framework, there cannot be a sort of strong disproportion between a more sustainable industrial development and economic development and in fact, transparent and ethical commitment of the finance, which has to back it up. So this strategy includes a clear call for greater transparency, as I was saying, which should enable investors to integrate social and environmental sustainability risks into their investment decisions, thus allowing them to assess the potential adverse impacts of their investments on the environment and society. So what once was considered in terms of externalities, so be it positive or negative externalities, should now be strongly incorporated within any kind of business governance, of any kind of financial management of assets and of the economy. So that's the kind of theoretical and practical leap that the EU is trying to boost. Specifically, the SFDR is responsible for listing and describing the financial instruments used in investments and during financial transactions, and for certifying and ensuring that financial flows produced by different transactions do not finance what are considered unethical or controversial markets, or non-sustainable activities as well. So that's where the let's call it new transparent finance should meet the EU taxonomy for, let's say, inappropriate industrial endeavors. Let's call them this way. Even though, well, we might discuss it later. So this is one of the points which are rather interesting to point out, because in the face of such a new policy, which calls for a different and more sustainable, more transparent finance, within the EU taxonomy, for example, nuclear energy is considered an appropriate tool for the ecological transition. And this is one of the main struggle actually between this policy and the other and the different policies which has been brought about in the last 20 years by, as I was claiming, FEBEA and Banca Etica, since in the let's call it hardcore ethical finance framework. nuclear energy should not be, the nuclear sector should not be financed. Is one of the forbidden sector, actually. This is one of the first, and it has been one of the first differences, and one of the interesting one as well. Maybe on the practical side, not more on the theoretical, but for further discussion, it might be interesting to point it out. So, although the SFDR represents an important first step at institutional and European level, many ethical and sustainable finance actors still do not consider it enough. A first reason for dissatisfaction is related to the voluntary element of disclosure. Individual financial intermediaries can choose whether or not to provide more transparency on their investment products and strategies. The element of voluntariness is also an indicator that the new approach to transparency promoted by the SFDR might not represent a truly new paradigm within financial practice, but rather a known structural addition to the financial apparatus that manipulates information without making it truly accessible or understandable. In particular, the element of voluntariness seems to raise two questions, one of a more theoretical kind and the other one of a more practical kind. So the first question concerning the effectiveness of a disclosure of this kind concerns whether a voluntary practice is sufficiently strong to ensure that, starting from the evolution of financial practice in the sense desired by it, it can then have such effects as to lead to the recognition of concepts such as long-term sustainability and the preservation of economic value for future generations as theoretical cornerstones of a new economic financial approach. The second question is, as mentioned, of a more practical order. Can a disclosure on an exclusively voluntary basis succeed in involving a critical mass, a critical number of practitioners, such as to generate a significant impact? And in retrospect, can it allow us to assess the actual effectiveness of a more transparent and ethical financial approach, if it should remain on a voluntary basis, and if it should remain in a way, non-mainstream, since it's voluntary, actually. So if it remains connected to the goodwill or to the bad conscience, as someone would say, of huge financial intermediaries. A radically alternative proposal is instead represented by ethical and sustainable finance, which proposes a new governance model that shows itself able of including investor and society as participating actors within financial practice, guaranteeing them full inclusion as access to complete and easily understandable information. So according to the Manifesto of Ethical Finance proposed by the Ethical Finance Association, European Ethical Finance Association in 1998, so quite a few years ago, transparency is a form of guarantee of participation because it is internal to financial practice itself. So the Manifesto claims, depositors have the right to know the financial institution's operating processes and its employment and investment decisions. It will be the responsibility of the ethically oriented intermediary to provide appropriate information channels to ensure transparency about its activities. So, through transparent governance mechanisms, the active participation of investors thus takes the shape of, I still quote, direct mechanisms for indicating preferences in the allocation of funds, as well as democratic mechanisms for participation in decisions. So ethical finance, in this way, becomes a promoter of economic democracy. And in this way, it seems to bring together the two different definitions of transparency that I proposed at the beginning of my talk. So the one that concerns transparency as a form of boosting economic health of any kind of institution, and the other one which claims that transparency within financial market would be a good way to promote good decision-making within finance and also boost its resilience towards external shocks. In the latter case, transparency in financial activities and products moves within a radically alternative paradigm because, unlike the classical efficiencyist financial approach, openness and the circulation of information does not behave as a generally disregarded tool to establish the value of price of a product, nor does it behave, as in the case of the SFDR, as part of a strategy to force sustainability issues into the financial markets. Within an ethical and sustainable financial approach, transparency is a powerful and indispensable tool in financial practice. So such importance can be read as much from a practical application point of view as from a theoretical one. In the first case, as clearly stated in the manifesto, transparency is one of the tools needed to make financial practice itself more democratic and equitable, and make it an efficient engine for fair and sustainable socio-economic development. Equity and sustainability, in fact, are guaranteed as much by the availability of information as by its inclusiveness. So the more transparent the information, therefore, the more comprehensible it will be to the various actors involved in financial practice. In this perspective, wishing to continue the analysis of the concept of transparency from a theoretical viewpoint, it assumes absolute centrality, so much so that it can be used as a pivotal concept which distinguishes ethical and social economic and financial theory from other theories, especially from the classical one, so from the mainstream one. The role played by the concept of transparency within the latter approach, in fact, could be somehow equated and contrasted with the role played by the concept of information within classical market theory, thus ensuring a clear distance in both theoretical approach and practical effect. So in this sense, another difference between these two alternative approaches would be that the notion of transparency itself, not by itself, of course, because to determine a different, to set a theory apart from another one, of course, we would need more elements than that. But transparency would somehow take the place of the place that the concept of information has within the neoclassical theory to describe how information and how models for so the epistemic structure and the epistemic possibility of agents within a market. So this is the end of the talk.
And thank you very much, Giulia, for this stimulating talk and also the information that you gave us. And we can now open the debate. And if there are people willing to ask questions, please raise your virtual hand and I will manage the queue. Otherwise, I have questions okay, we have Ekaterina. Hi, Ekaterina.
Yeah, hi. Hi, good evening.
Pleased to meet you again.
Yeah, hi. So many thanks for the talk. I would like to come back to the ideas that you mentioned in the beginning, that information is kind of disconnected from the idea of transparency. And then you kind of presented indeed two separate issues, right? On one hand, the role of information in efficient market hypothesis and the crisis of 2008. And then you move to discussing transparency notions as ethical long-term alternatives, so to say. But so what I think is interesting to discuss is the relationship between information and transparency. So it was a little bit disconnected for me in how you presented it. I'm sure you have thought a lot about it, right? So because for me, if we talk about ethical long-term transparency, information should certainly play a role in it, right? So it is not a complete opposite. Information should play a role in how transparency is achieved. And so how exactly does it happen? Because I think, yeah, okay, maybe first you thoughts and then I will continue.
Okay, no, thank you very much for this question. No, I perfectly agree with you. Yeah, you cannot take information apart from transparency if you actually want to discuss transparency, because transparency without information would be would be empty. Actually, it's an empty concept and it has no effectiveness. The only reason why I kind of disconnected them a bit, because actually it was a matter of time. Because, of course, one of the big problems concerning information and transparency is the question, what kind of information can I provide in order for it to be transparent, to boost transparency? Because it has to be understandable. So what kind of information can I provide and have so the possibility for the different actors in the markets, which are not simply big or small investors. There are also normal savers, so to say, that they want to invest their savings in finance. So that's really interesting. And it actually opens up a huge discussion of what are the actual, on the one side, what are the actual epistemic needs of investors in the market to act rationally. So a different description of rationality, one which might be more attained to a different kind of finance, not just because it has to be more realistic, as Keane, for example, would claim, but also how can I so for my goal, which is to maybe participate in a better development, of course, I need a specific kind of information, and I have to understand, and that will be the problem of both of the practitioner and the theoreticians as well. I think, because it opens up a huge problem in this sense. But yeah, you cannot take them apart in this case.
Yeah, so but I also think that in finance, it's particularly important to think about limitations of information available due to radical uncertainty and so on. And so very often we have kind of idealistic understanding of transparency as a possibility to provide all necessary information or being able to provide all necessary information. But in finance, we all very often have limitations, and also there is ethical literature, for example, on the limits of informed consent in finance, right? So we have to inform our clients, or institutions have to inform the clients about the products, possibilities, future possibilities in the market, but it's simply not possible. So how to provide, to be transparent in such a situation? And I think this is a very important connection between information and transparency in finance, right? So on one hand, yeah, it is difficult to make information understandable. So this is one limitation of transparency, but the second limitation is, of course, that information might not be available, and yet we have to be transparent. And I think this is a big challenge that we face in finance specifically.
Yes. Yeah, I agree with you. I would also add that it's not only in finance, but in some sense, if
health.
No, I mean, I was just thinking about transparency in terms of open government. It's a huge challenge in this sense, in this respect as well.
Yeah. So I think it's interesting to think how to be transparent in face of limited information or information that might be essential but unavailable. Okay, so I don't want to take the floor. Thank you so much for your talk. Thank you.
Thank you for your question.
Okay, I don't know if there are other questions from the audience. Okay, there is Liza. Okay, thank you, Liza.
Yeah, sorry, I couldn't find my virtual hand just now. Thank you for the talk. I'm a bit unclear as to what you see the difference between the EU Action Plan and the Ethical Financial Association with respect to methodologies of improving transparency. You know, the EU Action Plan has a certain aim. We're trying to get companies to disclose, activities that, would be supporting sustainable finance or inhibiting it, so on and so forth. And I just wasn't entirely clear how you see those two being opposed. And this was toward the end of your talk, because you suggested there were two different models, and it wasn't clear to me whether those models, had to be opposed in some way, or could they be integrated depending on how information is given and, presented to investors. So if you could say a little more about that, I just wasn't quite clear.
Thank you. Yeah, maybe opposed is a bit strong as a term to describe what I meant. As I said at the beginning, they cannot be overlapped. So in a sense, it might be a good way that they cannot be completely overlapped, because if we take it from a theoretical viewpoint, we might be somehow feel free to say that if you keep disclosure, the requirement of disclosure, let's talk about this in terms of transparency, on a voluntary basis, you may face the problems that I mentioned. Okay, but if you have to think about it on a more practical way, on a more political way, it's probably the best way to start and integrate these new, let's call it, sensibility towards corporate sustainability, corporate disclosure. So I think it's always a distinction that needs to be done. It's kind of a gray area. From a theoretical viewpoint, I would say that it does mark a difference, because, as I claimed, I have the feeling that from a more ethical viewpoint, so the viewpoints of the older practitioners, transparency actually works as a benchmark. A benchmark in the theory they actually use to promote their actions, whereas in the EU political plan, it's more of a way to soften the burden of a specific way of making finance. It is as if within a more ethical perspective, transparency is considered within the complex system of economy, whereas in the EU policy is more of an external tool to answer to a crisis. But I would keep these two sides separate, because so if we that's my opinion, if we take it only from a scientific viewpoint, they are kind of opposite. But if we have to evaluate them in terms of their effectiveness, it's kind of unfair to.
Yeah, this goes maybe back to what you said at the beginning. They have different aims.
They have different aims.
Yeah, well, that makes sense. Okay, thank you.
Thank you.
I don't know if there are other questions, but maybe I have one. It's a kind of comment, Giulia, and so just to have feedback from you in the sense. So transparency requires also theories. You mentioned the efficient market hypothesis. As you perfectly know, there are other theories that make strong claims on the raw information, so the heuristic and biases, fast and frugal. And so to be transparent, maybe the institution should be transparent, or the regulator should be transparent on what kind of theory you are employing. Because if you're using, for instance, heuristic and biases, even though you provide all the necessary information, you still can provide a bad decision. You can make a bad decision because there are cognitive limitations and so on, and that will make the agent go wrong in several ways. While if you are committed to the fast and frugal theory, as a politician, for instance, or as a policy writer, you will believe that there are a few information, fast and frugal information, that will push the agent towards the right decision. And so they are very different, but they require, they claim that information is important for transparency, but they will tell you very different things of what kind of information is necessary, and probably at what time and what are the rules to disclose all this information. So maybe there is a kind of meta question here, has to be, you must be transparent to be transparent, you must be transparent on your theories in order to be transparent to the practical level. I don't know if it makes sense to you, and what's your thoughts about it?
No, it makes perfect sense to me, and thank you, because I think it connects to what we were saying with Ekaterina. So it's important to understand the structure and the nature of information, which can actually implement transparency. And it's also interesting because I think there is always a threat somehow in speaking of transparency by itself, or fair information by itself, because it always opens up to any kind of political appropriation of this kind of concepts. And it's part of what I think one of a trend of thinking that theories are not important anymore. So that as long as you act in a certain way, you don't need a theory to answer to. And that's very interesting, because it's the opposite. I think it's the opposite way around. So you need a theory to assess what you're actually going to implement, or what you aimed at. So yeah, it should be very important to say, this is the theoretical framework I move from, because especially in social sciences, the theory you are using does not simply determine if you are going to have a good descriptive model or not, or a good predictive model or not. They may themselves actually create the reality that their own models wish to describe or predict. So I would say that from a scientific viewpoint, it would be the honest way of proceeding, to be actually understandable, to actually provide a description of transparency of how it might actually work in a social system. And also, I would say from a practical and political viewpoint, it would be honest to say what kind of theory are behind specific policy aims. So yeah, thanks.
Okay, so if there are no other questions,
May I ask one more question, maybe?
Okay, yes.
Yeah.
Thank you.
I'm just curious, what is your opinion? Should we maybe have audience-specific transparency requirements, so that, for example, financial institutions should be transparent to shareholders in one way and to regulators in the different way? Because my feeling is that each audience would require different information, and so that transparency requirements should also vary. Or would you say we need kind of one transparency framework that could apply to all audiences?
That's a good question, because I would say that it might different in time. For example, I was thinking, this afternoon, for example, that FEBEA, one of the association that I mentioned earlier, of the Federation of Ethical Bankers, in the last 3 years, they have been investing a lot of money in education, but education at very early level of so for primary schools or secondary schools, finance educations. They are trying to promote programs within the schools for it. And I think that kind of policies looks forward for having a single framework of transparency. So if you do have significant basis to understand finance, then you may, just like for history, I would maybe not physics or mathematics, but for history or economics as well, or anthropology, if you can study them and have the right basis, then you can have access to strongly structured information. Up to now, I would say that maybe 3 or 4 different frameworks would be the right choice, of course. because I see it as an ongoing process.
All right, thank you so much. Thank you.
Thank you.
So, okay, if I don't see other questions coming from the audience, and I thank Giulia again for being with us today, and it was a pleasure to discuss this topic with you, and hope to see you soon on the Finance Online seminars. And so the doors are always open for you.
Thanks.
And so I hope to see you. I see Caterina in the next talk.
Yeah.
And the next month. And so thank you again for being us today.
Thank you very much for your
Thanks.
space and your questions and attention. It has been a real pleasure.
Thank you so much. Yeah. Have a nice evening.
You too. Bye.
Bye-bye. Ciao.